Hello and welcome everyone to Antipodes' presentation on shopping global consumer opportunities. Just a brief introduction to Antipodes. We're a pragmatic value manager. We're focused not only on cyclical but also potential structural change impacting global industries and businesses. And nor do we limit our money-making opportunities to specific regions or sectors. That makes us a truly global investor. For just over 2 years ago, we started with a highly experienced investment team of 9 investors, and since then we expanded the team by another 3. And ultimately, we aspire to generate absolute returns in excess of the benchmark over the investment cycle at below market levels of risk. Now, regarding our philosophy on slide 3, the investment returns we generate are a function of 3 core factors. It begins with the starting valuation, or the price you pay, which is commonly referred to as margin of safety. Secondly, we seek stocks that feature business resilience, which is the economic performance of the underlying business you own, and also the durability of that performance. Resilience is enhanced by the more ways your investment case can win. In our DNA, we call that having multiple ways of winning. Finally, manage portfolio risk. We do this by monitoring the build-up of correlated known and unknown risk by the creation of clusters and limiting that risk exposure to 15%. Essentially, the heart of our philosophy is risk, because if you manage risk well, returns will follow. Slide 4. This slide just makes note of some current portfolio clusters that I was describing before, such as US software incumbents, which includes stocks like Microsoft and Cisco in the portfolio. Korean generational change is another significant cluster, and that's got holdings including Samsung Electronics and Hyundai Motor. And some shorting opportunities that target beneficiaries of that high-yield debt bubble that we've listed. Now on slide 5, Antipodes Partners is a proud active manager with multiple levers at our disposal that help provide portfolio downside protection and generate alpha. We can do this through buying stocks, shorting stocks, and managing global currency. Now I just want to point out that shorting is a critical differentiator for our clients. And remember, the investment case for a stock to short is just the opposite approach of a long. In that we look for zero margin of safety and multiple ways of losing. Moving on to some market observations and portfolio positioning. On slide 7, before we get into discussion around some of the consumer holdings, it's worth highlighting some of the market distortions that have helped generate those positions, both on the long and short side. So for example, this chart on bond rates highlights how low today's rates have become despite real and nominal GDP rates tracking not too far from what is their actual 15-year averages. So the lower for longer phenomenon we've all heard about has helped re-rate defensive stocks, or what we call expensive defensives or bond proxies, including branded consumer goods and infrastructure companies in developed markets, to historically high and vulnerable valuations. On slide 8, we've used the CAPE, or cyclically adjusted price earnings valuation measure, for domestic-only facing sectors, and those sectors include banks, retailers, services, and infrastructure stocks. Now the thing that stands out is North America leaving everybody else behind, and that was happening even before President Trump got elected in November 2016. Our preference, as contrarians in nature, is to be hunting for relatively cheaper but just as valuable businesses hiding in those less popular regions highlighted on the chart, like Europe and South Korea. Moving on to the heat map we have on slide 9. Quantitative analysis serves a key role in our investment process. In this example, the quant team has generated a heat map that organises the world into regions and sectors according to their valuation today versus their 30-year average versus the world. The colours you can see are measures of standard deviation, with dark red being very expensive and dark blue being very cheap. Now the key observations include the expensive defensives that are boxed there in red, both from a domestic sense in North America and global sense across developed regions, but less so in emerging markets. Conversely, the cheap territories in blue are domestic defensives in Europe and developed Asia, and also financials in those same regions. Because this presentation is focused on the consumer sector, on slide 10, we've taken a deeper dive into the heat map. Clearly you can see here the historically expensive segments include US foods, and by that I mean stocks such as Kellogg's, Campbell's Soup, Kraft Heinz, those kind of businesses. And it's no surprise with tobacco being there, expensive given the extraordinary pricing power that industry has in what is a low rates environment, and also beverages across most regions. But for the buying opportunities, the best hunting prospects potentially lie in broadline retail across all regions, and food right through to specialty retail in the developing or emerging markets listed there. Now on slide 11, most of our consumer exposure is actually in emerging markets, and we've provided the regional breakdown here on that slide. The bulk of 7.7% you can see in the top right is in China, and that's what I'll focus on here for the moment. Some of the Chinese company logos are displayed along the bottom. Now starting from the left to right along that bottom is, in blue, Jiangxi Yanghe. Yanghe is a highly profitable producer of Chinese white spirits liquor, which the locals refer to as baijiu. The alcohol content is typically a fire-breathing 40 to 60%, so be warned, if you're ever tempted to try, beware. Yanghe dominates its local provincial market of Jiangsu and has been expanding successfully into new territories in other provinces. The business is differentiated from its competitors with its aggressive marketing model and entrepreneurial management style, encouraged by nearly 20% stock ownership in the business. Next along there is Bell International. Bell is a Chinese footwear manufacturer and retailer and sports shoes retailer. Interestingly, just last week we received a takeover offer for this holding via an all-cash management private equity buyout proposal. And previously the stock had experienced a 70% washout following the government's anti-corruption crackdown, which severely impacted the department store sales channel for Bell's footwear business. That led to a massive inventory overhang that needed to be cleared, and also there was competition from China's fast-growing online channel that was hurting. But while the market was extrapolating zero recovery in this business, we still saw opportunity and value in its share of a two-player retail market selling highly sought-after Western sports brands like Nike and Adidas. And despite the prior weakness in footwear, it still commanded a 25% market share and a balance sheet of net cash and a very low sales multiple last year of just 0.6 times. Thirdly, next along is JD.com. JD is often referred to as the Amazon of China. Alongside Alibaba, JD dominates China's online retail landscape. The key difference between the two local giants is that JD, like Amazon, sells its own inventory, whereas Alibaba's websites are more of a platform service, and if you like that's more like eBay. JD has built an unparalleled owned and operated warehouse and delivery network that reaches all the way to the consumer's front door. The company's founder, Mr. Liu, focuses relentlessly on quality control and customer service. And despite the 40% annual growth rates, we still think there's more to come with this business. On the far right there is Tingy. It's a Chinese food and non-alcohol beverage specialist, which has been in recovery mode since we bought it. There have been two drivers behind that recovery. Firstly, its dominant noodles business with an extraordinary 50% market share of China has started to grow again. And that's come on the back of higher pricing from new and innovative premium products. Secondly, the beverage business, which includes the bottler and distribution business for Pepsi's brands, along with its own brands, has started increasing revenues and operating profits again after falling for over 2 years. Now if we move on to slide 12, here we've included Office Depot. Office Depot, it's actually a top 10 holding. And I think what it does is it showcases nicely how the art of investing always has exceptions to the rule. So while I was earlier highlighting that US domestic focused sectors are trading expensive levels, Office Depot is most definitely not. It's reminiscent of the North American tech incumbents that we already own, like Microsoft, Cisco and NetApp. They're almost left for dead by the market, actually not too long ago. We see similar appeal in this unloved incumbent, specialising in US retail and wholesale office supplies. For Australian listeners, you can think of the Officeworks business here locally as a good comparison. Whilst the products sold like paper, pens, school accessories, some office furniture, technology hardware, printing services may not be sexy to most investors, we are very attracted to its margin of safety and duopoly-like competitive dynamics. In addition, we think it can survive the challenge Amazon is presenting by already matching it for price and shifting 65% of its own sales onto the online channel. And quite tellingly, this is the benefit of being an incumbent, Amazon still only has 10% of the buying power of Office Depot for office products. So, as parts of the business will clearly shrink, we think other parts of the business can grow, while significant cost savings can still be stripped from the network. And in the background, we've got lurking another possible attempt to merge with the number one player, Staples. That attempt was made not too long ago, and the regulators recently knocked it back. But in summary, the stock is cheap with multiple ways to win. Slide 13 is showcasing Hyundai Motors in Korea. This is actually our largest portfolio position, with close to now, I think, 4.5% invested in that business. Now, I can remember 20 odd years ago when I was getting my driver's license and friends were starting to buy their first car, just how popular the Hyundai XL had become. I'm sure many of you remember it too. It might have been junk on wheels, but it was the first real new car that students, or for the lucky ones, their parents, could actually afford to buy. It was just so cheap. Now, 20 years on, and Hyundai is a very different proposition for global consumers. The brand now represents affordable quality on wheels, with a full range of models including SUVs and electric vehicles. And despite having to compete with incumbent global auto giants like Toyota, Volkswagen or General Motors, Hyundai has been able to grow its market share to 90% globally. Even our banking analyst, Sonny, bought a Hyundai SUV last year after his mechanic had told him to buy Korean if he wanted to stop visiting and forking out thousands of dollars on repairs. That's just one point of reference, but the chart to the top right of the slide nicely quantifies the reliability of Hyundai versus its peers. And the pipeline looks strong with a new product cycle underway, with more of the popular SUV models coming and more electric vehicle models by 2020. Now, I'm the first to acknowledge the global automotive industry is one of the most competitive on the planet, but we get Hyundai Motor with all of that potential or multiple ways to win for less than half the valuation of its peers. Slide 14 is currency, one of our three active levers that I mentioned earlier. Our starting foreign exchange position when we buy foreign stocks is typically neutral, as the margin of safety we demand is far greater than for a stock. This chart indicates currencies to the right are looking expensive relative to their history, while currencies to the left have become relatively cheaper. We continue to think the Chinese yuan will likely become cheaper in the future and have hedged out roughly 30 to 50%, and reallocated that into cheaper currencies like the Norwegian kroner, which we think should appreciate given its Fort Knox balance sheet, a 900 billion odd sovereign wealth fund, there's housing price pressure and elevated inflation tracking around 4%, just to name but a few ways for us to win. Slide 15 is a short example. Now, one of the fantastic benefits of being a global investor is having the ability to find more ways than one to make money from the same investment thematic. One might call it the gift that keeps on giving. In this case, the rise of the global athleisure phenomenon is one such example. To date, this has generated both long and short opportunities for us. But today, I'll be focusing on the short side. Now, the concept of athleisure was created in the late 1990s and quickly grew from the grassroots into a global juggernaut. I mean, who doesn't own a pair or 10 of those tight-hugging leggings that make you look, or at least feel, 10 years younger? And once you've finished your workout or yoga class, you can leisure along to lunch or back to work in the same outfit. Lululemon has been at the forefront of the athleisure trend, which we think has swelled into bubble territory. After starting its retail empire in Canada, Lulu then rolled out into the US and is now taking on the world. In 2016, it generated sales around $2.3 billion US. It is one of the most profitable retailers in the world with operating margins of around 18%. And that, of course, is helped by being able to charge $100 to $150 per pair of those leggings. And that's where the multiple ways to lose begins. Whilst the premium end of the industry claims the fabrics are high technology, that's difficult to replicate, we don't agree. We prefer to think barriers to entry are low. Remember, fast, profitable growth attracts competition. And so now everyone from Beyonce to Gap to H&M to Nike to Adidas to Forever 21 are all in on the act and filling their stores with similar athleisure apparel. That, of course, creates pricing pressure just at the time it seems demand is starting to taper because most people who are ever going to wear the style have already filled their closets. And a replacement cycle is never going to be as strong as the original overhyped growth cycle. Finally, as Lulu expands beyond North America, it will have to contend with greater supply chain and organisational complexity as it enters new markets to compete with already well-established local markets. And you can think of here locally, you can think of Lorna Jane as an example. The other athleisure-related stock listed on this slide that we've had success shorting is Eclat Textile. It's a Taiwanese listed manufacturer. Further up the athleisure supply chain from Lulu, Eclat manufactures the threads that get weaved into the premium apparel styled by the likes of Lulu, Nike or Under Armour. And it too has enjoyed a meteoric rise in revenues over the last decade, profitability and return on capital, which we think are ultimately unsustainable for what is a manufacturing business at the end of the day.